welcome to the third session on accounting principles. In this session, we'll be talking about what a trial balance is, what are the methods to prepare a trial balance, what is a provision, what is a reserve, what are the types, what is a bill of exchange, what is a promissory note, and all. Then let's quickly get into the topic. And I am Priyanka, and I'll be helping you with this session. So, yes. So, what is a trial balance? All right. Think of a trial balance as a big list that shows all the accounts that you have in your business. Okay. It might be cash or the sales or purchases, whatever. Okay. And secondly, how much money is on the debit side and how much is on the credit side. It's made at the end of a period, like probably like a month end to check. So if debit is equal to credit, your basic max in accounting is right, right? So if they don't match, you've made a mistake somewhere. For example, imagine you keep two boxes, one for money coming in and one for money going out. At the end of the month, you count both the boxes. If the totals match, what your notebook says is right, right? So how can you define a trial balance now? So, a trial balance can be defined as a statement that summarizes the balance, that summarizes the balance, be it credit or debit of a different ledger accounts, right? So, why is a trial balance prepared? What are the objectives? To ascertain the arithmetical accuracy of the ledger accounts, whether the accuracy is right mathematically. Then to help in locating errors. Then to help in the preparation of financial statements. Understood? So now let's move on to how to prepare. What are the methods of preparing a trial balance? So generally there are three methods: total method, balance method, and total cum balance method. We'll talk about total method right now. So in total method, you only write the total amounts of debit and credit from each account. You do not calculate the closing balance here. Okay. So at the end of the day, total debit will be total credit. For example, you have a cash account. So the debit total will be 20,000 and credit total is 5,000. So in total method, you just write 20,000 debit and 20,000, I'm sorry, 5,000 credit in the trial balance. Okay, in the credit column. This you write it in the debit column, this you write it in the credit column. So likewise, you only write the total amounts of debit and credit from each account. So let's move on to a balance method. So what is a balance method? Here, you find the closing balance of each account. First, debit balance or credit balance. Then you only write that balance in the trial balance. Example, again, in the same cash account, the debit total is 20,000. So the credit total is 5,000. So the closing balance will be 15,000 debit. In trial balance, you write 15,000 in the debit column. You get it? So next will be the total cum balance method. This is like a mix of both the accounts. Here, you write the debit total and credit total of each account. Then you write the closing balance. So debit total will be 20,000. Okay. Credit total is 5,000. So 15,000 is in the debit. In trial balance, you have three columns for each side: total and balances. Okay. So in short, total method will be the just the total of debit and credit. Balance method will be the just the closing balances. So total cum balance will be both the totals and balance together. Yes. So what is classification of errors? So whenever you have a, whenever you make a trial balance, it is bound to make errors, right? So so we try to classify what are the types of errors that might occur. So here we have error of commission, then you have error of omission, then you have errors of principal, then you have compensating errors. So when we do accounting, sometimes we make mistakes. So these mistakes are classified into all these four types. So errors of commission will be, you did record the transaction, okay, but you recorded it in the wrong way. Or here wrong way means probably the wrong amount or wrong account or wrong side, debit or credit side. Okay. Example, you received 500 from Ramesh, but you recorded it as 50 rupees or credited Suresh instead of Ramesh. Things like that. So next will be errors of omission. Here you forgot to record the transactions completely or partially. Example, you pay the electricity bill but forgot to write it in your books. Errors of principle will be you recorded the transaction in the wrong type of account, breaking the basic accounting rules. Buying furniture is an asset, okay, but you write it in the expense. So here you kind of break the basic accounting rules. Compensating error is two or more errors cancel out each other. They cancel out each other. So, for example, you overstate sales by 1,000 rupees, okay? But then you also overstate the purchases by 1,000 rupees. So they balance out each other by accident, right? So, what is errors of commission? Here you did the transaction, but you recorded it in the wrong way. In omission, you forgot to record the transaction completely or partially. In errors of principle, you record the transaction in the wrong type of account, breaking the basic account rules. In compensating error, two or more mistakes cancel out each other, so the trial balance still matches. So how do you rectify these type of errors? So first, these can be rectified by in two stages: before preparing the trial balance or after the preparing the trial balance. So when this before, it is easy, just erase and rewrite if books are not closed, or pass the correct journal entry here. Example, you recorded 50 instead of 500, so change it to 500 in the ledger book. It's quite easy. So second will be the after the trial balance is prepared. Here you have to pass an adjourning journal entry to fix the error. Example, you credited Suresh instead of Ramesh. Pass an entry to reverse the wrong credit and give the right credit. So what are the guiding principles? First, how do you type? First, you'll have to find what is the type of error. Type of the error, okay? Either it is commission, omission, principal, or compensating. See whether it affects the trial balance. If balance does not tally, it is an error on only one side. If it tallies, it might be a compensating error on both sides. So then decide what kind of correction method you can use. Before trial balance, current in the ledger. But if it is after, you will have to pass journal book rectifications. And also, fourth will be you should never erase in the final books. Always pass entries in audit proof, okay? Then also the next one will be follow double entry laws. Every correction must have both debit and credit, double entry. So these are the ways you can try to identify the errors and how you can correct it. And also there are some of the guiding principles of rectification of errors, which is quite, you'll have to memorize it a little bit, probably just revise it twice or thrice, that you will have to do it by yourself. That would be just the gist of this. For example, if an error is committed in the books of original entry, then assume all the postings are done correctly. Example like that. Sometimes, if error is in posting to a wrong account, okay, then assume that the posting has been done on the right side and with the right amount. So there are certain guiding principles that will actually help you to find out the error. So find out all that by yourself. It is quite easy. It's just a one page read. So try to read that. So next we'll move on to depreciation. So depreciation, what is depreciation? So depreciation is a decrease in the value of an asset over time, right? So how does a So how does it depreciate? Because of it may be because of the usage, or it may be because of the time, and it may be because of obsolescence. What is obsolescence? Because it might be outdated. So in accounting, depreciation is recorded as an expense every year. So depreciation is expense, okay, every year to show that the asset is slowly losing its value. So, for example, if you buy a new bike for 60,000, after 3 years, it won't be the same, right? Maybe only 30,000. So, the fall in the value is called depreciation. So, how do you define depreciation? So, depreciation can be defined as the decline in the value of an asset due to the use, passage of time, or obsolescence. So, you'll have to remember the three things: cost, the useful life of it, the net value of it. Okay, these are some points that you'll have to remember for depreciation. So what are the features of depreciation? So yeah, I'll write it here. So the features would be fall in asset value. It always means a reduction in the book value of assets, right? Like buildings or machinery or furniture. They will have a decline in the value. The decrease happens slowly over time and it's not temporary. So it's permanent and gradual depreciation. It doesn't happen overnight. Then also it is related to tangible fixed assets. Applies to things that you can see and touch, not land. Land usually doesn't depreciate so much. So caused by use or time. So wear and tear from the usage and everything. So recorded as an expense. This is a very important point. Depreciation is always recorded as an expense. Following the matching principle in accounting, we record depreciation each year. So the assets cost is matched with the revenue. Matching principle. This is also been asked as one in the previous year. And depreciation is a non-cash expense. It's a non-cash expense. And based on historical cost principle, depreciation is calculated on the original cost, not on the market price. So these are some of the points that you'll have to remember. Depreciation, it is a non-cash expense, and it is an expense, and then it is calculated based on the original cost. All right. So yeah. So let's come to what is the difference between amortization and depreciation. So amortization means it is applied to intangible assets, like the things that you can't touch, that doesn't have a physical form. Example, patent, copyright, goodwill, all that comes under. Okay. So this is like a value drop for non-physical assets. This is like a value drop for physical assets. I think now you'll be able to differentiate between this. So this is for intangible. So this will be tangible, right? So this is non. I'm sorry. This is for tangible, right? So this is for amortization is for non-physical. So this would be physical. So this will have legal rights, expiring over benefit. Then it's usually straight line come method. So a patent, say for 50,000, it might expire in 5 years. So here it is not straight line method. It has various methods: straight line method, reducing balance method, and various methods. And here a machine worth 1 lakh, say, it losing value over 10 years. So for example, all that happens. So depreciation and amortization, I think you get it. Depreciation is for tangible fixed assets and amortization is for intangible fixed assets. Okay. I hope you get it. So now, after you know that a value is depreciating, sometimes you'll have to dispose the asset, right? And how is the disposal of asset calculated? What is a disposal of an asset? It means selling, discarding, or removing an asset from the books because you no longer own it or use it. When does it happen? You sell the asset to someone else, or you throw it away, or it's destroyed by some natural calamities or accident. Okay. So, what are the different steps for disposal? First, you remove the asset from the books, then you remove the accumulated depreciation, then you find the book value, that would be the assets cost minus the accumulated depreciation. So you compare the book value with the sale proceeds. If sale proceeds is greater than the book value, so you have profit on the sale. But then if the sale proceeds is lesser than the book value, which means you have loss. So this is how you do it. So what is a disposal of asset? It means selling, disregarding, or removing an asset from the books because you no longer use it or own it. Okay. So what are the methods of calculating a disposal of assets? So there are few methods. We'll just talk about some of the main methods: the straight line method and the down value method. So what is a straight line method? So straight line method, here the asset loses the same amount of value every year. So it will be calculated like depreciation is equal to cost of the asset minus the scrap value by useful life. in years. Okay, so if a machine costs 1 lakh, scrap value is 10,000. So life is for 5 years. So depreciation would be 1 lakh minus 10k divided by 5. So it would be 18,000 per year. So this is calculated via straight line method. So written down value method is also known as reducing balance method. Reducing balance method. Okay. Here the formula would be book value at the start of the year. At start into the rate of depreciation. So it would be 1 lakh and the rate of depreciation is 10,000. So it will be first year it is 10,000. So second year it would be 9,000. So for third year 8,100. So it will go on like that. You get it? So these are the two types of important methods. So in straight line method, the asset loses the same amount of value every year. But in written down method, the depreciation is charged at a fixed percentage on the book value each year so that the amount decreases every year. Right? So these are the two types of methods in depreciation. So right now, next we'll talk about provision. So what is a provision? Okay, so provision is the money kept aside from the profits, okay, to meet a known liability or expected loss in the future, even if the exact amount or date is uncertain. This is to cover the expenses or losses that are likely to happen. For example, provision for bad debts, customers who do not pay. Okay, so provision for depreciation, provision for tax, all that are examples of provision. So provision is like a compulsory charge against profit. It's recorded before calculating the net profit. So how do you define provision? So provision would be, it's like a money kept aside from profits to meet a known liability or expected loss in the future, right? So what is a reserve? So in the next topic would be what is a reserve, then we'll have to differentiate. So reserve will be a money set aside from profits to strengthen the financial position or a specific purpose or a known liability. So this is to meet the unexpected needs, expansion to improve financial position. Okay. Example: general reserve, capital reserve, dividend equalization reserve, all that. So reserve is an appropriation of profit, whereas provision is a compulsory charge against profit. Okay, so it is done after calculating net profit. But here, but in provision, it was recorded or calculated before calculating the net profit. Get it? So how do you differentiate provision and reserve? So this is for provision, it is for a known liability or expected loss. This is for strengthening a financial position of a asset. Okay. So next is it is charged against profit provision, but here it is an appropriation of profit, and then the nature is it is charged against the profit. Yes, I said that, right? So next would be all right. So next we'll move on to the types of reserves. I hope you understood between what is a provision and what is a reserve, right? So, and also I forgot to mention this. In provision, it reduces taxable profits. In reserve, it has no effect on the taxable profit. So the types of reserves would include general and specific. Okay, so in general, just like the name says, it's just without a specific purpose. This has specific purpose. It is used for any future need. But then this has a specific purpose. It's also called free reserve, general reserve. For specific reserve, it is created for a specific purpose and can be used only for that purpose. Example: dividend equalization reserve, debenture redemption reserve, workman compensation reserve, all that. We can remember that. Dividend Then debenture redemption reserve example. Okay. So again, the specific reserve, just remember all these examples, general and specific reserve. So again, if you could see, these are the types of reserves. But then reserves are also classified as revenue and capital. Revenue and capital based on the nature of profit. So what is a revenue reserve? Revenue reserves are made from revenue profits, just like the name suggests. So what are the examples? It can be general reserve or workmen compensation fund or investment fluctuation fund, all that. So next would be the capital reserve. So what is a capital reserve? They are also created out of capital profits that do not arise from normal operating effects, such as not available for distribution as dividend. So example for capital reserves would include profit on sale of fixed assets, then you have profits prior to incorporation, then premium issued on shares or debentures, all that comes under capital reserves. Okay, so what would be the main difference between revenue reserve and a capital reserve? So revenue would be created out of revenue profits which arise out of normal operating activities of the business and otherwise available for dividend distribution. But capital reserve is, it is created primarily out of capital profit which do not arise out of the normal operating activities of the business and not available for dividend distribution. Right. So these are the main differences between revenue and reserve. And also, if you can talk about the usage, for a specific revenue reserve can be utilized only for the earmarked purpose, while a general reserve can be utilized for any purpose, including distribution of dividend. Though this is something very important. Then there are two terms. What is a suspense account and a secret account? A secret reserve. So I'll talk about secret reserve first, because since we have been talking about reserves. So just like the name suggests, so when the total depreciation, all right, when the total depreciation charged is higher than the total depreciable cost, a secret reserve is created. Okay, so it is not explicitly shown in the balance sheet, but this might come in the MCQ. So when the total depreciation charged is higher than the total depreciation cost, so secret reserve is created. So we'll talk about what is a suspense account. So what is a suspense account? So okay, so if the trial balance does not tally, okay, due to the existence of one-sided errors, accountant has to carry forward his accounting process to prepare the financial statements, right? So the accountant tallies his trial balance by putting the difference on shortest side, known as suspense account. So a suspense account is like tallying the trial balance by putting the difference on the shorter side. So that is called as suspense account. So next would be the bill of exchange. So what is a bill of exchange? Okay, so bill of exchange, I think you might have heard about this. Example, I'll start with an example. Say a person A sells goods to B worth of 10,000. Okay, so A draws a bill on B saying, pay 10,000 to me or to C after 3 months. If B accepts, signs it, it becomes a valid bill, right? So what does this mean? A bill of exchange is a written order by one person, that is a drawer, to another drawee to pay a certain amount of money to a third person, he is the payee, or to himself after a fixed time. Okay, it's usually used in trade between buyers and sellers. So, a bill of exchange is a written order by one person to another to pay a certain sum of money to a third person or to himself after a fixed time. So, that is called bill of exchange. So, and why is it collected with promissory note? So, promissory note is also, it's like a written promise by one person to pay a certain sum of money to another person after a fixed time or demand. Say if B writes to A, I promise to pay you 10,000 after 3 months. Here B is the maker. B is the maker. So A is the payee. So that is the promissory note. So what is the difference between bill of exchange and promissory note? So bill of exchange would include, so bill of exchange and promissory note. Here it is made by the drawer, the creditor or the seller. Here the maker is the debtor or the buyer. Right. So the parties involved is three: drawer, drawee, the payee. Here you have two: the maker and the payee. Here an order to pay. Here a promise to pay. This is a promise. This is an order. Okay. Here, do you need the acceptance of the drawee here? Yes. Do you need it here? No. This is mainly used in trade transactions. This is used in loans, often in loans and borrowings. So these are the major difference of bill of exchange and what promissory note. I hope you understood. I'll again tell you, a bill of exchange is a written order by one person to another to pay a certain amount of money to a third person or to himself in a fixed time, right? So promissory note will be a written promise by one person to pay a certain sum of money to another person after a fixed time or on demand. So these are the explanations for this. Next is the maturity of bill and discounting of bill. So what is maturity? Maturity is the date in which the bill becomes payable. So how is it calculated? To term the bill, 3 extra days or grace days are added. Okay. So say if Priya has to pay a 3-month bill dated 1st January. So it's a maturity date. So it will be 1st August plus 3 days. It will be 4th April. So that is the maturity date. So what is discounting of a bill? If the holder of a bill needs money before maturity, okay, so he needs money before maturity. So what does he do before? So he can sell the big bill to the bank. So the bank pays him the bill amount minus some charges called discount. So at maturity, the bank collects the full amount from the drawee. Example, bill amount is 10,000. Okay, maturity is in 3 months. Bank discounts it today at 10% per annum. So discount is 10,000 into 10% is into 3 by 12. That would be 250 rupees. So the bank will hold 250 rupees. Okay, and then will pay you 9750. So that is the thing. So what is a bill of exchange? It is an order to pay. Promissory note is like a promise to pay. Maturity is due date plus 3 days. Discounting will be selling bill to the bank before the due date or less, right? So these are the things. I hope you understood the session well. I'll just give you a quick summary of this so that you can understand it even better. So what is a trial balance? So trial balance is like it is a big list that shows the accounts that you have in your business, right? And also how much money is on the debit side, the credit side, and everything. So you have total method. It's like a total of all the amounts. Balance method is the most common. It has the closing balance of each account. So total comp balance method will be the mix of both the accounts. Then you have three types of errors. So in commission, you have recorded it in the wrong way. In omission, you forgot to record the transaction completely or partially. So in principle, you have broke the basic accounting rules and wrote it in the wrong type of account. For compensating errors, two or more errors will cancel out each other. So how do you rectify errors? So you can check it before the trial balance or after the trial balance is prepared, and you have certain guiding principles on how to rectify errors. And then we saw about amortization and depreciation. So what is an amortization? What is a depreciation? Depreciation, it's a decrease in value of an asset over time. This is for intangible assets and this is for tangible assets, right? Yeah, so depreciation, so amortization will be value drop for non-physical assets. This would be value drop for physical assets. Then we saw about disposable of asset, that is selling or discarding the asset from the books. So you, because you no longer need it. So next would be depreciation. So we saw the definition. What are the methods? Straight line method and written down method. Right. So what is a straight line method? Here the asset loses the same amount every year, but in written down, the depreciation is charged at a fixed percentage on the book value each year. So the amount decreases every year. So it's not the same. Next would be provision. So yeah, what is a provision and what is a reserve? So provision means the money you kept aside from the profits to meet a loan liability, right? So, what was reserve? Reserve was like a money you kept aside from the profits to strengthen the financial position of a for a specific purpose. That was for reserve, and we saw the types. There were two types of reserves. One was general and specific, and another based on the profit was revenue and capital. Right. So next we saw about bill of exchange and promissory note and maturity discounting of bill. So, in case if you have any doubts in any of these sections, please let me know in the comment section. I would definitely help you out. And in case if you want me to make a video on a particular topic, please let me know. I will definitely take it up. And thank you for patiently listening to the session. Please like and subscribe to the channel since it's a very new channel, and your like or comments or subscribing to the channel would mean a lot to me. Thank you.